Welcome back to The Edge, the podcast where we dive deep into the strategies that separate the professionals from the rest. I'm your host, Robbie, and today we're tackling what many analysts call the single most volatile asset in any market. And it's not crypto, oil, or gold.
That asset is you, the person sitting in front of the screen.
Exactly. And to unpack this, I'm thrilled to introduce our guest, Gelsana Willie, a behavioral finance expert and veteran trader. Gelsana, welcome to the show.
Thanks for having me. I'm really looking forward to this conversation because honestly, this is the one topic that 99% of new traders completely ignore.
Let's start with a brutal fact from the trading world, the 90-90-90 rule. It's this unwritten law that 90% of traders lose 90% of their capital within 90 days. That's devastating. Is this purely a strategy failure, or is there something else at play?
It's almost never a strategy failure. A bad strategy might make you lose money slowly, but the 90-90-90 rule is driven by a lack of discipline. They have a profitable strategy on paper, but when real money is on the line, the human element, fear and greed, takes over. They can't execute the plan they worked so hard to create.
So trading stops being a numbers game and becomes what?
A psychological battle. It's the difference between a pro who sees a small loss as a simple cost of doing business and a novice who views that stop loss approaching as a catastrophe and impulsively closes the position, or worse, moves the stop loss because of blind euphoria after a win compels them to over-leverage. 90% of success in trading is mental.
Wow. That puts the focus firmly on the trader's internal world, not the external market.
You touched on fear and greed. From a behavioral science perspective, what is happening inside our brains that makes us so bad at following our own rules when trading?
It's a conflict of operating systems, essentially. Our brain is ancient. It's running software designed for survival on the savannah, not for modern financial markets. When you put real money on the line, the limbic system, our emotional center, gets activated. It's shouting, danger, fight or flight.
So our survival instinct is actually an enemy to our financial discipline.
Precisely. The brain hates uncertainty, and the market is the definition of uncertainty. To feel safe, the brain looks for patterns, even if they don't exist, and that leads us straight into our cognitive biases.
Can you give us a couple of those viruses in our mental software that are most lethal to traders?
Absolutely. Two big ones are anchoring bias and confirmation bias. Anchoring is when you buy a stock at, say, $100, it drops to $80, and you irrationally refuse to sell because your mind is anchored to that initial $100 price. You wait for it to return to its price, often leading to massive losses.
Right, the refusal to accept the new reality of the price.
Exactly. And confirmation bias is reading articles only forecasting a rise when you're long on an asset. You actively filter out any bearish news. You're literally ignoring data that contradicts your position just to feel momentarily right. These aren't moral weaknesses. They're evolutionary shortcuts that are legal in the modern market.
Emotional insights, taming the amygdala.
This brings us to the amygdala, the fight or flight center. The document mentions that the fear of losing money is twice as potent as the pleasure of gaining an equivalent amount. That's loss aversion, right?
That's Daniel Kahneman and Amos Tversky's foundational work in behavioral economics. When the market moves against your position, the amygdala is screaming. You can't just tell it to calm down. It requires subconscious retraining. That's where positive trading affirmations come in.
Affirmations? That sounds like magical thinking or just wishing for money. How does a simple phrase actually achieve neural reprogramming?
It's about synaptic plasticity. Affirmations are not empty wishes. They're intentional statements designed to create new neural pathways, like creating a new, smoother highway in your brain. You are actively replacing a limiting belief, like, I always panic when the stop loss is near, with an empowering one. I execute my stop loss without hesitation. With constant structured repetition, this new path of discipline becomes the default.
That's a great analogy. It reminds me of diverting a river. You start with small shovels, and eventually the entire flow of the river changes course.
The structure, trader-style smart affirmations.
So, if we're going to use them, they have to be structured correctly. You mentioned adapting the popular SMART framework. How does that translate for a trader?
We call it the trader-style SMART rule: specific, measurable, actionable, realistic, and timely. The key is to focus on the action and the process, not just the result.
Let's break that down with an example. Give me a poor example and an effective affirmation based on that framework.
Okay, a poor example would be, I'm going to earn a lot of money. That's vague, focused on the outcome, and isn't actionable because you can't control the market.
Too focused on the monetary result. What's the effective alternative?
An effective one is, I only enter trades with a 1-to-2 risk-reward ratio. Or even better, I am patient and wait for my setup now. Notice the present tense and first person. That's critical. Your brain needs to hear that the desired behavior is already occurring. It forces your mind to act as if you are already that disciplined trader.
I love that. Using the present tense, I am the calm amidst the volatility, instead of the future, I will be patient tomorrow. It makes it an identity, not a wish.
Practical application, the 7 pillars and the tack.
For our listeners, let's give them some practical ammunition. Your material lists the 7 pillars of the successful trader. If you had to pick 3 non-negotiable pillars to base your affirmations on, what would they be?
I'll give you 3 core ones because these are where most people fail. Risk management. This is the absolute priority. Your central affirmation should be, my capital is protected. I always use the appropriate position size that limits my risk to only 1% of my capital per trade.
Acceptance of loss. Loss is inevitable. Treat it like a utility bill. The affirmation, a loss is a lesson and a cost. I accept it calmly and prepare for the next opportunity. It detaches emotion from the financial outcome.
Focus on process versus outcome. This is how you achieve consistency. The affirmation is, my focus is 100% on executing my strategy.
I need a
The
price
result
check on the
is
euro.
merely
It's
a
moving too fast.
statistical
We have to hold.
byproduct.
Get me
If
out
you
of those
follow
bonds
your
right
rules,
now.
you win over the long run, even if the individual trade loses.
I love that. Using the present tense, I am the calm amidst the volatility, instead of the future, I will be patient tomorrow.
Se desploma.
It makes it an identity, not a
Vamos a la
wish.
quiebra.
Absolutely. And that wraps up this episode of The Edge. Thank you again to Gelsana for
Si
guiding
cae
us
por
through
debajo
the
de este
hidden
nivel,
power of the trading
cerramos la
mind.
posición.
Until next time, stay disciplined and trade smart.